Hello and welcome to our video about the 13 trading commandments. In this video I will share the 13 best, most powerful and the most effective tips with you that I have learned over the years. So I've been trading actively for the last 12 years. I had my first introduction to trading when I was 16, which is now 17 years ago. And over the years I have seen not only myself but with hundreds and hundreds of traders that I have helped and coached during or through Tradeciety, and I'm sharing them with you now. There's also a PDF ebook below this video which you can download and use for your own reference. So we are starting with trade entries. Obviously that's usually the first stage of a trade. So the candle close rule does sound very simple, and yeah, many people brush it off as too easy and not effective, but really pay attention to here. And what I have found in myself and with all my students is that if you can reduce your trading decisions to only the moment when the candle is closed or is closing, then your consistency can often increase significantly. What this means is that, for example, if you trade the 1 hour time frame, you don't look at the charts during the 1 hour. You only come back to your charts on top of each hour when the candle is closing, and then you make your trading decisions if you want to enter, but also if you want to exit a chart or a trade. And this will help you approach a more stress-free way of trading. You will reduce the noise in your trading performance, in your approach, and it will help you make much better trading decisions. You will often stay also away from false breakouts and fake outs, which happen during a candle close or during a candle formation. The second one is structure breaks. So especially in my trading, I often refer to myself as a breakout or a pattern trader. So I trade head and shoulders, I trade wedges, triangles, double tops, triple tops, and many other patterns. And all of those patterns usually have a very well-defined breakout point. So a neckline or support and resistance or a trend line or sometimes even a moving average. And I use those structures and those entry points as another filter mechanism for my trading. So I not only make trading decisions on the close of a candle, but I also only get into a trade when such a structure is broken. This means that I wait for a candle to completely confirm my trading scenario. I don't get into a trade before a market is or has broken out. And of course, this means sometimes you need to be more patient, but at the same time, it also means that often you will stay away from false breakouts and from trading decisions where you know they are not really ideal. We often know that we should not be in the trade. We often know, oh, this is a little bit too early, but we don't want to miss out, right? So we often get in a little bit too early. We should often wait one more candle to get the real confirmation or see that the setup is actually cancelled. And those two rules, the candle close rule, together with looking for actual structure breaks and waiting for the market to really break out of a structure, can often make a big difference. So now we come to trade management. The first one is no babysitting. There's really no need to sit in front of your charts all day. There's a very commonly shared myth about screen time. Many traders believe that the more screen time you have, the better of a trader you will be. This is completely wrong, and it is not true. Even when you go back to the first Market Wizard books, which have been written around 30 years ago by now, almost all traders say that you should reduce the amount of time you spend looking at your charts, because nothing good comes out of looking at charts all day long, and you will often just end up taking bad trades or making bad trading decisions. When you watch every uptick and every downtick, you get nervous and you often are just bored, and when there's nothing to do, we all know that this usually does not end well, right? Objective exits is very important. The general saying, the last objective moment of a trader or for a trade is the moment before you pull the trigger. Once you are in the trade, when the money is on the line, when we see the market is moving up and down, when we see our unrealized profits or losses go up and down, it is definitely clouding our thinking, and we not make objective decisions anymore. Now we often make decisions based on how much is to lose, how much is to gain, how much are we down now. So before you enter a trade, you really need to make sure you have set and determined your stop loss point. Where do you want to get out? What is the point where your trading idea gets cancelled? Also, on the other hand, what is a signal that will signal you to get out of a profitable trade? Where do you set your targets? And you really, really need to make sure that those are the points and things that you determine and define before you enter a trade. It will make a big, big difference. Don't trade the P&L. This should be obvious, and this should be one of the most important rules, but many traders don't adhere to that. In my trading personally, I even go so far that I have two computers. One is only for charting, where I only have my charting platform. I use TradingView mostly, and there I follow my markets, I follow the trading ideas, I look at the charts during the day, and once I have identified a trade entry signal, then I open my other computer where my broker platform is, and then I enter my trade, I set stops and targets, then I will close my broker computer again and go back to my charting computer. This way I don't see my orders in front of me all the time. I don't see my P&L. I don't see how much money I'm losing or winning. And this will remove a lot of emotional problems because, well, we all know that if we use the same platform for trading and charting, we always see our order in front of us. And then it's just a matter of one click to do something we know we should not be doing, right? We enter or we manage our stop loss maybe a little bit ineffective. We add to a loser. We widen our take profit. We jump into a trade. We jump out of a trade. And if you just remove the possibility to do that, then you can often see a big improvement in your emotional stability, because then, well, what happens is, okay, you see something on your charting platform, then it takes a few moments, you need to open your broker platform, and in those moments you usually have time to think about what you are about to do, and you will often catch yourself and think, oh, I know I should not be doing this, so yeah, hopefully you're not doing this. So think about how you can separate charting from trading, and it can make a big difference. The 10-second rule. I picked this up from Magnus Carlsen, who is the best or was the #1 rated chess player in the world. And he said that when he looks at a chessboard, he usually knows within a matter of seconds what to do, but then he just sits back and thinks about everything that is possible, that he could do instead. And he has probably seen tens or hundreds of thousands of different chess positions, and usually he probably will know what to do right from the beginning. But as we all know, the chess players usually take a lot of time to think it through, think about what could happen, what will happen, what are the options. And in trading, we should do that as well. We don't need to sit there for 30 minutes and look at a chart and think about everything that could happen, but at least taking the finger off your mouse button for a few seconds and really think about, okay, is this a trade that I really love? Is this a trade that is in alignment with my trading rules? Was this trade in my trading plan? Am I breaking my rules? Should I maybe wait a little bit longer? What am I overseeing? And this really doesn't have to take too long, but at least waiting for 10, 15, 20 seconds, pausing, leaning back and looking at the charts can make a huge, huge difference when you catch yourself, okay, now I know this should not be the trade that I need to be in. I need to give it one more candle. And yeah, knowing what to trade is important, but knowing when not to trade is also very, very important. Trade exits are another part, obviously. So now we know how to improve our trade entries a little bit. We know what to do when it comes to trade management. So what are we going to do with trade exits? Losses, obviously, are very important, and dealing with losses is very important. When you look at professional traders and even the best hedge fund traders in the world, they usually have a win rate of somewhere around 50%. So 45 to 60% is quite normal. And this means that the half of your trades are losing trades. So we really need to understand how to deal with losing trades effectively, because, well, we have losing trades every other trade. And a trader who does not know how to deal with losses will quickly have problems. And we need to make sure that, we know losses. We know how to deal with losses. And we don't get upset. We need to really put losses in their right context. Losses are not bad. Losses are not necessarily something that means we did something wrong. Losses are just something that happens. In trading, we deal with probabilities. We deal with a lot of uncertainty. So you really need to make sure that you detach yourself from the outcome. Don't see losses as something that is bad. realize the loss and move on. The best traders are not the ones who don't have losses. The best traders are the ones who can deal with losses most effectively. The trade as a hypothesis. I love this rule because it really helps detach yourself a little bit from the trade itself and don't take it too personal. The actual trade should always be seen as a type of chart hypothesis, something like if-then scenario. So for example, if you trade a breakout or a crossover into a new trend, your hypothesis might be, okay, the market has broken out of its range and now the bulls are in control of the market, and as long as the price is making higher highs and higher lows or staying above a certain moving average or whatever your rule might be, then your trade hypothesis is correct. And this helps you also to understand when it is not correct anymore. What has to happen that cancels your trading idea? What has to happen that just signals you to get out of a trade? And then you can often make much more objective trading decisions. It helps you realizing losses objectively when you don't see a loss as something personal, but just as something that, okay, you had an idea, your trade idea was a hypothesis, and the market just proved that your hypothesis was not right in this moment. It might be still working in the future or at another chart, but right now your hypothesis is just was proven wrong. Sample size thinking. This is something that many retail traders forget or just don't see the importance of it. So if you have the goal of becoming a professional trader and you want to trade for a living and you want to make your salary or your income should come from trading, you want to retire as a trader, then you really need to understand that you're probably going to be in this business for the next 10, 15, 20, maybe even 30 years. And over this duration, you will take hundreds and often thousands and thousands of trades. So you really need to put one trade into the right context and to see the perspective of things. One trade is really absolutely meaningless. If you're taking thousands of trades over the years, one trade should never have a significant impact on your trading account, on your mental capital. And you should never allow one trade to get out of hand. One trade is absolutely, completely meaningless. So if you see that, okay, this was a losing trade, you executed your trade correctly, you followed all your rules, but it just didn't work out. Don't get upset. Don't try to make it up. Don't try to do anything stupid. Don't add to losing trades. Take a loss, accept it, understand that there will be hundreds of trades coming in the next years, and then you just move on. Dealing with losses. Okay, I could probably write books about this, but here are 5 of the most important things. First of all, when you see yourself in a losing streak or you have a bad time, reduce your trade size. The worst thing you can do is get bigger because, well, maybe you think, oh, I want to get out of this losing streak faster, then you just double your trading size. Of course, it will take a little bit longer if you reduce your size, but often as a trader, it is not only about making a lot of money, but it's about protecting your mental capital. We can always get back the money, we can always recover from a losing streak, but if we lose our mental capital, if we get too upset, if we get too emotional, then bad things will happen, and protecting your mental capital through reducing your trade size is very important. Become more selective when you are facing a losing streak or you don't know what is going on, you see bad results. Then instead of trading more and trying to recover, trade less. Only trade the best setups. Go back to your trading journal and look at, okay, what has worked in the past extremely well, and then only take those trades. Only take the A+ setups and only take high quality trades. Manage your expectations. This is something that I could not stress enough. Many traders have a wrong impression about what trading really is. They are often hanging around in social media, or they watch some TV shows where they see famous traders in their with their $1 billion lifestyles, big houses, big cars, beautiful women, whatever. And then they think, okay, this is what trading is all about. And then when they have such expectations and then they are facing reality, there's a very big difference, and it becomes so very frustrating quickly when your high expectations aren't met, when you see, okay, reality is so far away from what I think trading could be, then you become frustrated, you become demotivated. But even worse, your trading will change often. You will take too much risk, too many trades, bad trading decisions, and expectations are really at the core of so many trading problems. Jumping in trades because you want to make a bigger trade or bigger profit. So really audit your expectations. See really what do you think trading is, and is this really realistic to achieve, and is it helpful? Objective loss analysis, something many traders forget, unfortunately. But not every losing trade is bad, not every winning trade is necessarily good. You need to look beyond that. You need to ask yourself, okay, why did I lose this trade? What caused it here? And then you have two options. One, you did everything correctly, you followed your rules and you followed your trading plan, and it just didn't work out. Or you are the one who screwed up. You broke your rules, you took a trade that isn't in line with your rules, and it wasn't in your trading plan. And looking at your losses objectively in such a way will provide you a very, very different view on your trading performance. Objectively looking at performance is such a big thing, and it can help you understand that are you really in a losing streak where over the last 3, 4, 5, 6 trades you did everything correctly and the market just didn't work out? Or over the last 5, 6, 7 trades you broke your rules and you just got the result that you deserved. Those are very, very different outcomes, and many traders believe that they are in losing streaks, but often they are not. They're just getting the result from poor trading execution. Revenge trading, well, everybody knows about revenge trading, and everything before that really comes back to revenge trading. If you are in a losing streak, or if you are just having a bad day, then what happens often, you enter a downward spiral. You follow up on, you chase trades, you chase price, you get taken out for a loss, then you jump back right in because you want to make up. And this is very, very bad. So revenge trading should be avoided at all costs. What I did in the beginning when I felt that I was getting emotional, I just closed my computer and I walked out. I either went to do some sports, I did some reading, or whatever might help you to get your mind off of things. And then once you come back to your trading desk, maybe an hour later, 2 hours later, or maybe even the next day if it's really bad, then things will look very differently, and you can understand, okay, this is just one trade. It did not work out, but there will be hundreds of trades coming in the future, and I need to be prepared for that. You cannot really allow one bad trade or one trade in general where it just didn't work out to have a meaningful impact on your account balance. Performance targets. Performance targets should be avoided. You can never control how many trades you can enter. You can never control how the market will respond to your trade. You cannot control how much you can take out of the markets. There will be periods when the market favors your system. There will be periods when the market isn't favoring your system. And having performance targets will always end up in a bad result. If you have a performance targets and you hit it very early in the week, then why should you stop trading? Maybe the market is just favoring your system and you can take much, much more out. Or you have a performance targets and you are so far away, but you want to hit it, and then you increase your size, you take more trades, and then you end up with losing trades, as you rightfully should, but then you are even further away from your performance target. Performance targets should not be made at all. And as Dr. Alexander Elder said in his book, the only goal of a trader should be to make the best trades possible. That's the only thing that you can really control as a trader. Making money is then just a result of making good trading decisions. System metrics. So when we talk about metrics, we can talk about many different metrics, but I am focusing here on win rate and reward to risk ratio because those are commonly used and also most misunderstood. Win rate is completely meaningless on its own. Reward to risk ratio is completely meaningless on its own. Whether you have a 20, 30, 40 or a 90% win rate system doesn't really matter without context. You can have a 90% win rate system and still lose money if yeah, if you just have very small winning trades and one giant losing trade that eats up all your profits. Many traders have problems with letting winners run and cutting losses short, obviously, and then even a high win rate is not good enough. Or on the other hand, high reward to risk ratio just works on the opposite. Many traders want to have a high reward to risk ratio system, but they don't really understand the implications of it. And only when you look at the two metrics together, then you can actually, yeah, I call it the holy grail in the PDF that you can download, and I really believe that it is. Once you understand that you don't need a high win rate, and once you understand that you don't need a high reward to risk ratio, your complete outlook on trading will change. For example, if you trade with a reward to risk ratio of 1:1, which is not large, you only need a win rate of 50% to at least break even. This is a mindset shift. Many people believe that they need win rates of 60, 70, 80%, or at the same time, they need a reward to risk ratio of 3:1, 4:1, 5:1. That's absolutely not the case. Often it is much more conservative what you need. You don't need a high win rate, you don't need high reward to risk ratio. It really all comes down to the combination, and in the PDF, in the ebook, there are a few calculations and examples how the two things work together. But really understand that you don't need either. You don't need a high win rate, you don't need high reward to risk ratio. You should approach trading from a more realistic outlook, and then your trading will change because you understand, okay, I don't need to stress about my win rate, I don't need to stress about huge winning trades, and then everything in your trading will hopefully change for the better. And that's it. In the PDF, I of course talk a little bit more about the individual concepts, so make sure to check that out. And there are also a few links below this video for further reading material. And if you have any question, make sure to always reach out to me. I'm always available via email. I'm always happy to help out. Until then, happy trading, and I hope to hear from you.